Do you get your money back from an annuity? That's an excellent question. Annuities are complicated products. You can't see exactly how they work behind the scenes, but you receive some pretty appealing promises and guarantees from an insurance company. Unfortunately, the sales presentations might not completely explain how things work, and you might think of questions after you're finished meeting with your insurance agent. You've got a big portion of your savings at stake here, and it's critical to understand how these things work. So let's talk about some of those key concepts. First question might be, when you put your money in, can you get it back, or how can you get it back? That's a big question. What happens to the funds in an annuity when you die? Whether you're taking income or not, what happens? Third question is, what if you change your mind or you just need the money for something else? What's it like to get that out of an annuity? As with most financial topics, there's no simple answer, but we're going to try and break this down into a couple of categories and give you the basic concepts, and then we'll continue on into all the details that you might want. So, first, we might ask if it's a deferred annuity. A deferred annuity is one that you can put money into and take money back out of, typically at almost any point. However, you may have to pay surrender charges when you cash out. So that means the insurance company keeps a percentage of the amount you withdraw, and you might receive substantially less than you put in or less than your account balance. Sometimes you get 10% for free, and then they charge a surrender charge on top of that. Next situation might be if you're taking lifetime income. If you set up an irrevocable, series of payment that lasts for your life, you or your heirs might not get anything after your death. That is, unless you use something like a period certain or a couple of other options. A period certain would guarantee that the payments come to you or your heirs for 10 years, for example, even if you died after year two. Next is flexible income. These are what you might call income riders that can allow you to stop taking income and cash out, but you might not have assets to walk away with, depending on what happened in that annuity between when you started and when you want to stop. And finally, we need to mention taxes. You may owe taxes on withdrawals, especially if you cash out of an annuity, and that can reduce the amount that you have left for spending. So certainly talk with a CPA to look at the details of that if you're considering taking money out of an annuity. Now we're going to get into a lot more detail and cover some examples. I quickly want to mention, if you're planning for the next chapter in your life, you're trying to figure out what to do next, you're trying to sort out what might be good advice and bad advice, I would be happy to talk with you, and we may be able to work together. So please get in touch with me if you'd like to explore that. There's no obligation to talk. So let's get into a couple of examples. We're going to start with the most flexible situations, and that means it's easiest for you to take money out. And then we'll move on to increasingly inflexible situations. Just briefly want to mention that inflexible isn't necessarily a bad thing. If you give up all of your options, then that typically results in you getting the highest monthly income or annual income from an annuity. If that's what's most important to you, then that's not necessarily a bad choice, but you want to understand these trade-offs between flexibility and what might be your income. So the first example is a deferred annuity, and an annuity is, in its most flexible form, just an account that you can put money into and invest the money and get the money back out if you want, but it does have those tax restrictions. It is an insurance contract, and the insurance company can also set restrictions on how you use the contract. But you could potentially move the money out to a different annuity or transfer it out to an IRA, for example, in some cases, if it happens to be a retirement account. And these are all assuming that it's a deferred annuity and not an immediate annuity that you are taking that lifetime income from, or a longevity annuity might also be complicated. But with many of these deferred annuities, you can just cash out. You can have them send you a check or move the money somewhere else. Beware of those surrender charges. They can last as long as 20 years. It's a really long time to not have your money flexible, but some contracts do that, and they can take a big chunk of what you withdraw. So please check carefully before you take any action. The way to find out about that is to contact your insurance company. It's often a great idea just to call the 800 number, not necessarily the agent who sold it to you, because the customer service people at the 800 number might know more about the product and the operations of what you might want to do. But just talk with whoever you trust the most and you think will be the most helpful. Our next example, example 2, we're talking about income from living benefits. And living benefits is in quotes. That's a term for these features that an annuity might have. Typically, it's something like income, right? So you might be getting income for life. They might call it, 4% or 5% for life. And that's not necessarily an irrevocable choice. So if your source of income consists of you calling the insurance company whenever you want money, there's a good chance you can just walk away with your money whenever you want. You would just ask for the full amount, or you can again have that transferred. A Section 1035 exchange, that's the name of an IRS code. We're getting pretty detailed here, just bear with me, may allow you to move money from one insurance contract to another without triggering tax consequences. But again, it's critical to visit with a CPA and review the insurance contract carefully to make sure you get that right. So those riders or living benefits often have some flexibility. They might let you walk away with whatever is left in your contract. That is, of course, after paying surrender charges, taxes, whatever other charges there might be. The thing is that the value of your principal, the value of your original investment might have gone down. It typically does decrease when you take income from the account, but if there's anything left, you can take that in a lump sum if you want. But be sure to look at the numbers and review that. In some cases, you're actually better off leaving it in there, especially if the principal value, the cash value, has declined substantially. You might be in a better place if you just leave the funds where they are, which is not a fun place to be. There are no good choices there, but you want to at least know what is best. Third example, this is the one where you annuitized. It's called annuitizing, and that is the traditional view of a lifetime annuity. So this offers guaranteed income for life. It typically offers the highest monthly or annual payment, a little bit higher typically than those riders or those living benefits. So it's an old-fashioned annuity where you put in a lump sum and you just keep getting that money for the rest of your life, however long the rest of your life happens to be. If you live to be 120, you win. And if you die within the next year or two, typically that is less beneficial. But if it helps you meet your needs, again, that's a choice that only you can make. To find a middle ground or reduce your risk, you can choose what's called a period certain, and that would be maybe 10 years where you keep receiving income from the annuity for sure. And if you die before that, your heirs would get the income for whatever remaining number of years there are. But again, if you live to be 110 or whatever, you may continue to receive the income for the rest of your life. It would just be smaller if you chose that period certain, because you reduced your risk and you increased the insurance company's risk. Again, check your contract for complete details. Some other things to talk about: if you die while you have money in an annuity and you're receiving income, everybody wants to know, if I die in a year or two or whatever after buying an annuity, do they just get to keep all the money? And with a simple lifetime payout, just a single life, your life, for example, the answer is yes. The insurance company gets to just keep that money. Your heirs do not receive the principal when you die. Again, this is assuming it is not a deferred annuity. You have annuitized and chosen the largest monthly income, And that's a big risk if you happen to die shortly after starting that annuity. Pros and cons to that, of course. Next is if you're doing a joint and survivor payout, well, then whoever else is on there with you, it might be a spouse, for example, would typically continue to receive some payments. So that's a nice thing. If you did that period certain, as I mentioned, we've probably talked about that enough. That can keep the income coming for a couple of years. If you use a refund option, that would also protect you against early death. If you did not receive your principal back, for example, the insurance company might pay something to your beneficiaries. As you might imagine, this is reducing your risk and increasing the insurance company's risk. So they're going to pay you less if you take that route. Finally, you might do just a period certain only. So we're not talking about the option where you get paid for 10 years or the rest of your life, whichever is longer. With a period certain only, you just pick that exact number of years you want. It might be 10 years, for example, and the payments come for those 10 years and they go to your beneficiaries if you die in the meantime. Or if you live, the payments would end after those 10 years or after that period certain. So I hope this helps to paint a picture of what you might expect with annuities. Please read your contract carefully. This is not individualized advice. It's an overview to help you understand how these things work. Please talk with a CPA, a tax preparer, whoever looks at your taxes, and go through the details with them. I cannot overemphasize how important that is. And again, if you would like to talk, please let me know. We might be able to work together. I work with people who are not in Colorado, so we can work online or by the phone. I have, encrypted and secure meeting technology and file vaults that you can upload things to. And I can explain all that to you if that all sounds kind of foreign. So would love to chat with you. And again, I hope that helps. Take care.